Welcome to Talk Tickers. We dive deep into earnings calls, pulling out the essential insights for experienced investors like you.
Yep, doing the digging so you don't have to.
Exactly. Today, we're getting into the Aptiv Q1 2025 earnings call. We'll give you the snapshot first, then really unpack the details.
Sounds good. And Aptiv's Q1, well, it was a bit of a mixed bag on the surface, but pretty interesting when you look closer.
Right. Let's start with that snapshot. So revenue came in at $4.88 billion. That's actually down 1% year over year.
A slight dip, yeah. But that's not the whole story, is it?
Not at all. Because operating income, a record. $572 million, which is up 5%.
And earnings per share, even more impressive.
Yeah, also a record. $1.69 per share. That's a huge jump, 46%.
46%. That really stands out against the flat revenue. And cash flow looked decent, too.
Strong operating cash flow, yeah. $273 million. They actually beat their initial guidance range.
So why have the beat? What did they point to?
Well, they mentioned a few things. Higher vehicle production in China than they expected.
Okay, China continues to be key.
Definitely. Also, strong growth in their non-automotive businesses and just, solid operating performance overall.
It suggests they're managing costs really well, or maybe shifting towards higher margin stuff.
Yeah, exactly. Making more profit even with slightly less revenue. Okay, let's dig into that revenue figure a bit more, that 1% decrease. Where did it come from?
Primarily lower vehicle production, specifically in North America and Europe.
Right.
And they also mentioned something called negative customer mix.
Which usually means maybe selling more to less profitable customers or, less profitable programs within customers.
Precisely. But it wasn't all down. They did see growth in what they call adjacent markets.
Okay.
And FX is a headwind too. Foreign exchange, especially the euro, the renminbi, and the Korean won drag things down a bit.
So region by region, North America.
Down 2%.
Europe, down 4%. But China, you mentioned production was higher than expected there. How did revenue look?
China revenue actually grew by 2%. And that's despite significant production volume drops with one specific EV customer they have.
Wow. Okay. So even with a major EV client pulling back, they still managed growth in China overall. That's quite resilient.
It really is. Shows the breadth they have there, perhaps.
Let's break it down by their business segments then. They've got Advanced Safety and User Experience, or ASUX, Engineered Components Group, ECG, and Electrical Distribution Systems, EDS. How did ASUX do?
ASUX revenue was basically flat overall.
Yeah.
But underneath that, you had strong growth in North America for that segment and also in the non-automotive parts of ASUX.
So those offset declines elsewhere.
Exactly. And within ASUX, active safety revenue was up 9%. That's a key area.
Definitely.
And their smart vehicle compute and software stuff, that grew by double digits.
That's significant. And the margin.
Record margin for ASUX,
Okay.
10.9% operating income margin.
Very strong. Okay, what about the Engineered Components Group, ECG?
ECG revenue was up 1%. And that was largely driven by that strong growth we talked about in China.
Makes sense.
Their operating margin there was also really good, 17.3%. That's a big jump from last year.
17.3, wow. Okay, and the last one, Electrical Distribution Systems, EDS. This is the business they're planning to spin off, right?
That's the one. EDS revenue declined 3%, mostly tied to lower light vehicle production globally.
But any bright spots there?
Yeah, actually.
Right.
Commercial vehicle revenue within EDS saw strong growth. So trucks and alike.
Okay, and the margin for EDS?
7.1%, which they noted was an improvement. They put that down to footprint optimization, basically streamlining their factories.
Got it. So optimizing ahead of the separation, perhaps.
Seems likely.
Okay, moving on from the segment results. What about new business, future pipeline?
Looked pretty healthy. New business bookings for the quarter were nearly $5 billion.
A solid number.
And China was a big part of that again. Over $1.4 billion in new awards came from China.
But they did mention some headwinds, didn't they? Tariffs?
They said the recent tariff announcements and just general regulatory changes have caused some delays. Customers are pausing on awarding some programs.
Adds a layer of uncertainty then.
It does. Something to watch.
And strategically, they announced a couple of interesting partnerships.
Yes, they did. One with ServiceNow that's aimed at commercializing edge-to-cloud offerings, sort of taking their tech beyond just the car.
Into the broader enterprise space. Interesting diversification.
Yeah. And they also expanded their partnership with Cap Gemini. That's focused on next-gen private cloud solutions.
So definitely pushing more into software and services.
Absolutely. It signals a clear strategic direction.
And that EDS separation, still on track.
Yep, they confirmed it. Still aiming for completion by the end of Q1 2026.
Okay, let's talk outlook then. What are they telling us to expect for Q2?
For the second quarter, they're guiding revenue between, $4.92 billion and $5.12 billion.
Which is what compared to last year?
At the midpoint, that's down about 1% year over year. So similar trend to Q1 top line.
And profit expectations for Q2?
Operating income around $575 million at the midpoint, and adjusted EPS around $1.80.
Okay. And the full year, did they update their initial outlook?
Not formally, no. They said they're comfortable with their initial full-year view, excluding any tariff impacts.
Ah, the tariff caveat again.
Exactly. They're basically saying, look, we need more clarity on how these tariffs will actually play out before we bake them into the numbers.
And their original outlook assumed, what about overall production?
It already assumed a decline in global vehicle production for the year, so they're already being somewhat cautious.
So how are they planning to handle these potential tariffs if they do bite?
Well, they're working on mitigation strategies. Things like, optimizing the supply chain further, more localization, building things where they sell them.
Makes sense.
And even potentially relocating some high-value production back to the U.S.
Interesting. Reshoring possibility.
Could be. But they also made it clear that any costs they can't mitigate, well, those will likely get passed on to customers.
Right. The OEMs would ultimately foot the bill.
Seems to be the plan B.
Okay, finally, let's touch on financial health. Balance sheet, shareholder returns.
It's pretty solid. They completed that big $3 billion accelerated share repurchase program they announced.
So shares bought back.
Yep. And they've been aggressive on paying down debt. About $700 million paying down already this year, which they said is way ahead of schedule.
Good sign. And leverage.
Net leverage is at 2.2 times. They highlighted strong liquidity as well. And they also mentioned a continued focus on cutting SG&A costs, selling, general, and administrative.
So tightening the belt where they can.
Seems that way.
All right, let's try and synthesize this for our listeners. For experienced investors looking at Aptiv, what are the key takeaways here?
Well, I think first you see the resilience. Navigating a tricky market, especially with that strength in China and the growth outside of traditional auto.
Right, the non-automotive segment.
Exactly. Second, the profitability is undeniable. Record operating income, record EPS that shows strong execution, good cost control. Third, though, is the uncertainty. The tariff situation is a big question mark, and how that might impact OEM production in the second half, that needs watching closely.
The known unknown, perhaps?
Sort of, yeah. Fourth, those strategic moves into tech partnership ServiceNow, Cap Gemini, that signals a potential diversification, a growth story beyond just car parts.
Expanding their addressable market.
Potentially. And finally, the financial discipline. Buying back shares, paying down debt ahead of schedule, that shows a focus on shareholder returns and keeping the balance sheet strong.
Good summary. Okay, that brings us to our favorite speculative corner. The "This is not financial advice" segment. Time for some outrageous but plausible trade ideas based on this call.
All right, let's brainstorm. Given Aptiv's clear strength in China, right, even with that EV customer issue and their focus on localizing, here's one thought.
Okay, let's hear it.
Maybe consider a pair trade. Long Aptiv, short a big European supplier that's heavily reliant on the old combustion engine tech and maybe doesn't have quite the same China exposure.
Interesting. The rationale being?
Well, the idea is Aptiv keeps benefiting from electrification and software trends, especially in China's growth market. Meanwhile, the hypothetical European player faces headwinds from the ICE decline and maybe slower growth in their main markets.
Yeah.
You're playing the divergence.
Playing the tech shift and the geographic strength? I like it. Okay, my turn. How about this?
Go for it.
We saw Aptiv pushing hard into software, edge to cloud, with those partnerships. And there's this whole narrative around, potential reshoring, more automation, maybe more high-tech manufacturing coming back to the U.S.
Okay, where are you going with this?
So maybe long Aptiv combined with a short position in a more traditional pure play component maker, someone with limited software smarts and mostly manufacturing outside the U.S.
Ah, so you're betting on Aptiv leveraging those tech partnerships and maybe catching a wave of U.S.-based advanced manufacturing.
Right. While the other company, the traditional one, gets squeezed by the tech shift and maybe tariff issues if their footprint is wrong.
Another interesting angle, both ideas really lean into those key themes from the call: China, software, trade dynamics.
Absolutely. And just to be crystal clear, these are just thought experiments. Plausible, maybe outrageous, definitely not financial advice. Do your own homework.
Couldn't say it better myself.
Yeah.
These are purely for discussion.
So wrapping up our deep dive on Aptiv's Q1 2025 call, it really shows a company managing a complex world pretty effectively, hitting some record profit numbers despite revenue headwinds.
Yeah, strong execution in key spots. But those clouds, tariffs, future production levels, they're definitely still out there.
For sure. The strategic moves in tech and the upcoming EDS separation are definitely things that could shape their future. They seem to be positioning themselves proactively.
Agreed. Lots to track going forward.
Absolutely. And remember, everyone, this analysis is purely for informational purposes. It is not investment advice. We always encourage you to conduct your own thorough research.
So what are your thoughts out there? How do you see Aptiv's strategy playing out? Think tariffs will be a major disruptor? We'd love to hear your perspectives.
Please do join the conversation.